Everybody in the entire financial world is short upside calls on crypto, right? What that means is the more the price goes up, the more regulation changes, the more they have to get involved. I've seen a setup once like this before, which was the launch of the GSCI Commodities Index back in the late 90s. And basically nobody had commodities in their portfolio. Everybody went to about 5 to 10% weighting, right? The amount of buying was in the hundreds of billions of dollars. The magnitude of what needs to happen here and the fact that everybody's short means that over time they all get flushed in. And all the conversations I have are with the biggest financial institutions on earth, whether it's the sovereign wealth funds, the biggest asset management firms, the biggest family offices, the biggest pension funds. I mean, it's on everybody's radar screen. And incrementally, every bit of news you get that's positive on regulation, or somebody like BlackRock showing the way, or somebody like Texas Teachers showing the way, or somebody like Fidelity showing the way, makes people braver and braver. You know, when you look at what Goldman is doing, JP Morgan's doing, I mean, you're giving confidence to more people. All they need is a bit of price action and they'll be in.
The crypto market is inching up slowly but surely as Bitcoin traded above $25,000 for the first time in 9 weeks, trading at $23,800 at the time of writing, while Ethereum cracked the $2,000 level, currently trading at $1,860. Both coins are a ways away from their all-time, but the recent sentiment across the crypto market has been positive due to the recent uptick in bullish headline. BlackRock announced a partnership with Coinbase and also announced a private Bitcoin trust for their interested clients. The Ethereum merge testnet has been successfully executed, giving the ETH faithful a very optimistic look. Macro investor Raoul shared his optimistic view as a guest on the Crypto Banter podcast. Raoul believes as more and more regulatory guidelines are released, the institutional money will feel safer to come into the space, and Raoul suggests that they are chomping at the bit to do so. Raoul also believes that the merge for Ethereum is the turning point for crypto. Raoul hasn't been shy about his love for Ethereum, famously wearing his irresponsibly long t-shirt and stating that he doesn't even look at the Bitcoin price anymore, only ETH. However, in his view, what's coming with it can be the biggest thing we've seen before.
The point being is the big pools of capital, whether it's people like Apollo or Blackstone or BlackRock or everybody, sees yield, right? They didn't own gold because it didn't have a yield, and it's difficult for them because they have the hurdle rate we talked about before for so many of their clients. But it's a bigger story than that. It's much bigger than a supply and demand story. What we're actually creating is the benchmark interest rate for Web3. So this is the big daddy of which all risk will get priced against. Everything in the world is Treasuries plus or LIBOR plus, everything. Sure, in Europe, Italian spreads are Bunds plus. So we have an ability to now price risk. So how does this work? If I look at the Solana staking yield, which is higher than the expected ETH yield, once you adjust it for the volatility of the underlying currency, much as you would do with emerging market bonds, well, they match. So you've got pricing relativity. You can understand what's mispriced, what's not priced, where the risk actually lies. That creates an explosion in DeFi. Because once you have a proper yield curve, that you have and again, I'm going to use the term because people don't fucking understand it, is risk-free rate. The risk-free rate is the fact that the ETH yield will be guaranteed. What won't be guaranteed is the value of ETH. So same with the US dollar. If you buy US dollar bonds and you're a non-US investor, the bond yield will go, the currency will go up and down against you or in your favor. So this whole setup is much larger than anybody expects. If we want to see where DeFi goes, this is the big unlock. It's also the big unlock for institutions. It's the big unlock for pension funds, as long as Kevin said, regulation comes as well. This is a much larger impact than anything that's happened in this space since the launch of stable coins and the launch of Ethereum. Look, I've got a very variant perception here. I think inflation goes negative in 18 months' time. I think the price of oil comes down to $60. I think everybody's a supply side analyst and nobody understands demand. I think the ISM, which is the driver of the business cycle, or the best kind of monthly indicator of the business cycle, I think it comes down to about 40.35. So that's a kind of negative 2% GDP print, which I think the markets will ignore for the reasons I said before, and the fact that the Eurodollar market is already pricing cuts for January. I do think that I think we're talking now at turning point in the cycle, right? And everybody just always looks at where we are today. Inflation's at 8.5%. How can you possibly think the Fed will cut? Well, the Fed have cut every single time in history since 1960 when the ISM has gone through 50. They've either cut or paused. They only paused once, which was 2016. Every single other time they've cut. So they talk a game, but growth leads inflation. I don't buy the structural inflation side of the story for this part of the down cycle. I can consider it for the next bull market and the next economic up cycle if we haven't built more supply in energy and some commodities such as copper. But copper's been screaming at you that inflation is not an issue. Every single commodity, from wheat to copper to aluminium to everything, is down 25 to 50%. It's only oil and gas for the reasons we know. And I think I think oil comes down to $60 anyway. Now, year on year, that's going to give you negative 50% oil price. So the headline CPI is almost impossible to be positive because of the year on year comps. So I think, so to sum it up, bigger, faster recession. I don't think it impacts markets. I think kind of as Kevin and Urin think, I actually think markets are fine. I think the bond market does extremely well because it's utterly mispriced. It's the most mispriced of all the other assets versus the business cycle. So that's why I'm wearing my buy bonds, wear diamonds t-shirt. I don't disagree with Kevin that equities will do well. I just like the risk-adjusted return in bonds. I love bonds because they're easy ways to make money generally. You know, to go to Ran, I think the most important point is if I think of the asset allocation process, right? My view is weaker growth. My view is the Fed come into play, i.e. they stop somewhere set or op. I think the bond market rallies. What do you want to own? You want to own the furthest out duration thing you could possibly own, which is crypto, which is why crypto based exactly around the same time as the market starts picking up that the Fed were going to pivot. So this moment the Eurodollar market starts pricing in cuts, crypto bases. So that's how I think of the portfolio allocation. I love bonds. I think they'll do well. I don't want them for yield. I want them for price appreciation. But the real game in town is going to be crypto.
To watch the full interview, check out the link in the description. What do you think of Raoul's thoughts? Here is the merge, the biggest thing in the space since stable coins. Leave a comment. If you're not subscribed, make sure to subscribe, as we put out daily content to keep you up to date on the current marketing news. Thanks for watching, and we'll see you in the next one.